Vlad Ethereum Classic.
What's up, guys? What's up, gentlemen? Capital gentlemen. So today we're gonna go over a couple things with the U.S. economy, how everything like PPI, PCE, CPI, jobs data being manipulated, rate hikes, rate pause, etc. Delinquency with credit cards, unemployment rate, global money supply, and Bitcoin disregarding net liquidity, and eventually, some short-term price action with Bitcoin CME futures yield curve versus unemployment, and total market cap with the cryptocurrency market caps, total one, total two, total three, breaking down. Um, but before we get into all that, I just want to ask you guys, go ahead, follow Capital Gentlemen, posting as much as we can on here. Just with general projections in the market in the short term when videos aren't able to be uploaded. And some things to make sure that you stay focused. Um, but besides that, make sure go follow Capital Gentlemen Twitter, subscribe to the YouTube channel, leave a like on the video so we can, get this information out and spread it around. But yeah, let's just get into the PPI data that got released today. So the month over month PPI increased to 0.05%. It increased um, um, it increased 0.02% for this month. Let me see. They don't have a lot of forecasts on here. Let me see. Do the inflation rate month over month, last previous producer price inflation. No. This is because this is the inflation data for last month. So, hmm, hmm, hmm. Oh, maybe I was reading it wrong. If this was from the month before that, then maybe they expected it to drop more than what expected. But I really don't think that's what happened. Unless let me just check this year over year. Am I tripping? Am I tripping? Uh, because I'm comparing it to what I have on paper. Consumer price. Okay, let me go back. Monthly index points. Maybe I clicked. Did I click the wrong one? Let's compare to the month over month and year over year. Right. Let me see this one. Oh. Okay. It seems U.S. PPI for financial demand, less energy, food increased from a revised. Okay. So basically, it didn't drop as much people were thinking it was going to drop. Apparently, um, because from what I got, from my source, the expected rate was. If I'm saying this wrong, somebody let me know. But from what I'm getting, the expectation was 2.3% on. Is this core year over year, or maybe core is down here? Yeah, it came in. Yeah, I guess the expectation. This isn't the expectation, but I guess it depends on where you get your expectation from. But I'll just say my expectation for the year over year. So core prices year over year, the expectation was 2.3%, came in at 2.7%. So it was higher than expected, which was not profit. Not I can't say, well, I mean shorts are going to short, but it wasn't good for upside with markets because people was expecting the inflation to come down. Month over month. I think this is the core month over month. Expectation was 0.02, came in hotter than expected. This is weird. It's like some of these resources have different totals. Like on my paper, I got like 0.05, and then maybe that's something I need to figure out on my off time. But I'll just I'll just cut it short. Basically, all the PPI data came in hotter than expected. That's just the general consensus, right? How that's going to affect CPI? If all the PPI data came in hotter than expected, then we can assume that they're going to charge consumers more. So the consumer price index will come in probably hotter than expected, therefore encouraging the Fed to increase with basis points on the next rate hike. Um, in my opinion, I'm not sure they have completely. I mean, technically, we're kind of in a pause, but maybe they're doing that a bit too early if they're not getting the results they want. So maybe they're gonna, especially how we're not gonna get a soft landing. We're gonna get an inflate. We're gonna not fuck. We're gonna get a recession, right? Like assuming that they're just trying to get this down and out, like with the they're trying to suppress the inflation. They're probably gonna raise basis point rate hikes, and if CPI is gonna go upwards of like or what's it called? If the bond market's gonna head higher because they raise interest rates, then they're gonna have to raise interest. Fuck, I may maybe hold on. No, if the bond market is gonna head higher because they raise the interest rates in regards to the inflation going on, because of the inflationary data that we have that right now is increasing, which is the opposite of what they want. I mean, it depends on which side of the yield curve is getting uninverted, but in the short term that would bring the shorter rates up, and then in the longer term I guess it could undo the uninversion that's happening right now, but kicking the can down the road isn't really helping anybody. But still we're in rocky territory in regards to how the PPI affects the CPI, and then how this is going to play into the rate hikes, and how US jobs data with unemployment came in hotter than expected, and then they revise it. Like all these government fucking numbers are always made up, but then at the same time they're basing it off shit that's constantly changing that they gotta revise, and then they do something to the economy that can't be revised. So it's like clearly the way you guys calculate the data is not the best, but they do it anyways. So kind of just going over that briefly. I mean, depending on how they revise data, and if the data's valid, then if they're okay, they take that into account. It doesn't need to be revised. Then maybe they don't, raise interest rate hikes. I don't know. They kind of have done that before. I think they did that earlier this year. But I think you guys ultimately get what I'm saying. Sort of. Not even sort of. PCE, PPI affects the CPI. Again, I'm just going over it just to make sure y'all aren't confused. With PPI affects the CPI. CPI is going to factor in whether they're going to raise, pause, or not. And then, obviously those raises, whether we go higher for longer. And if we're higher for longer, then, obviously QE isn't going to come back until later. So moving on, we can get into all that later if I get more ultra specific data, but that's not what I'm trying to do. So let's just dive into this. So let me see. New York. Okay. All right. Hopefully, what I need to come up is going to come up. Do. This is not what I'm looking for. Where, like, obviously, I want recent data, right? Like, Delinquency rate. Yeah, that was a title of what I wanted to show, but for some maybe is gonna have what I want to show, but oh, it does. Okay, great, great, great. Um, hmm, this is weird. Hmm, I think the data's a bit 2019 to 2020. Oh no, the data's accurate. The data's accurate. I was just confused for a second because this came out um in 2022, but this is exactly what I was looking for. So basically, with credit card delinquencies, because we started the rate hikes back all the way in 2021 and throughout 2022, they're starting to delinquent. With especially okay, basically, in my opinion, because of the rate hikes, how that's affecting the job market and the accurate job data is not being reflected in terms of how in terms of how stable jobs, the decrease in stable jobs or jobs that pay well is not being reflected. The Fed right now is trying to say that there's an abundance of jobs, but the question comes in: are these quality jobs? Are these jobs that can actually pay you? And they're also counting part-time jobs when people just have to pick up multiple part-time jobs instead of because they can't get a full-time job, right? And if all those factors come into play, the less quality of jobs, people having to pick up two different jobs that are not quality, then you're going to see delinquency rates creep up. And if credit cards are more delinquent on a national scale and banks aren't getting paid back, then that obviously is going to tie into net liquidity in the US getting drained. Right, because if they loan out that money and nobody's paying it back, and if let's say, you know, if higher percentages of people are unable to pay back these credit cards, then how much are these banks gonna have to take that blow? And then that's gonna channel in how does that affect customer deposits? And that could be something completely different, but net liquidity is getting drained um, from the from the credit card market. From I mean, in general, we knew that, but clearly here we can see is because here's the thing: if credit cards wouldn't be going delinquent if people had adequate jobs. You see what I'm saying? Notice how when there was access liquidity, this was going down, but it's not anymore. Um, but at the same time, um, actually, no, that's basically it. So moving on, right? I'm gonna go to. I'm gonna go here, and we're going to talk about the. Do I have to subscribe to get this shit? I hope not. Um, World two. We're gonna talk about the World M2. Yep, there we go. Talk about the global M2. So, this is shout out Cowboy Trades, right? I didn't know about this website, but shout out Cowboy Trades. Basically, I mean, I knew about M2 obviously, but I didn't know this was a available chart to use. So as we can see, Bitcoin follows access liquidity up, and when access liquidity is not present, it comes down on a cycle to cycle basis. That's just what repeats, right? And what we can see here is that with net negative liquidity, really, and just basically baseline liquidity being at zero, or no, not or growth being at zero or negative, um, we can see that Bitcoin doing these rallies is disregarding global liquidity. Um, because how do you realistically how do you have Bitcoin let me go on a more, yeah. Like, how do you have Bitcoin disregarding net liquidity and it's already pumped to 20K? Oh, no. My bad. That's from November 2022. Point still stands. Net liquidity was zero here, and it didn't get above the 0% for a long time, and we still pumped up. I mean, maybe because of that slight print they did a while back, but regardless, this is about global liquidity, not just Fed liquidity. So the fact that the argument is that Bitcoin has to follow the M2 world global, accounting for the Fed, ECB, Bank of Japan. What's the POC PBOs? I forgot that one. Is it down here? Is it down here? I forgot this one, but yeah, Bank of Japan, ECB, and Fed. The argument is that Bitcoin has to follow those things, and it was disregarding that liquidity temporarily, but I think a reversal is somewhat getting priced in, just because it's only a matter of time that it could disregard such a thing. Now, you guys might be like, okay, what's indicating reversal? Obviously, we had the textbook Head and Shoulders, but if you go back, right, what everybody's talking about right now is, this channel breakdown. You could look at it as a rising wedge breakdown. You could look at it as a Head and Shoulders breakdown from this other Head and Shoulders. Where is it at? Oh, it's over here from this other Head and Shoulder. Okay, God, what? Where is it? What? I have it. There it is. From this other Head and Shoulders, and all of these incorporate the bull market support band. And not only that, um, you have rejection at the 200-day SMA, right? That's been shown. You're not holding the 200-day EMA. That's been shown. You're going to be testing the 200-week EMA, and after the third time testing that at the 25K level, it's probably going to break. Probably. Testing at 50-week, violated a 50-week or 50-day EMA, violated, I'm guessing we're about, okay, we're holding that temporarily, but at the same time, didn't we just wick below that? Yeah, we wicked right into it, so that that's just gonna get fucked. And then on top of that, rejected from here, we got a lot of key rejection points playing out from this retest, so that's an indication to me that liquidity is gonna be breaking. One thing I did realize is that Bitcoin on the daily time frame, what was playing out was a rising wedge, and that's why we broke down. So I just want to let's just dive into it more specifically. So if we come over here, right, you have your higher highs, your lower lows, etc. We can know your higher highs and your higher lows, right? And you have your touch point, bam, lock that in. And then you have same scenario here, but key difference is like right there. And it's yeah, like that's basically rising ridge right there. And it broke down. I mean, deviation, right, and structure a little bit, but regardless, I mean, it depends. It doesn't even matter if you didn't draw it like this. If you wanted to be a little bit more ultra specific and you didn't want to draw it like that, okay, sure, right? Like, I'm sorry, it still broke down. So that's something I did want to point out real quick. That's a reason, because the momentum on the relative strength was about to, it was either going to get overbought and come back down, or it was going to break down before it went to overbought. And that's exactly what's happening right now. Obviously, this move was facilitated by an event, but aren't all of them, right? They all are. Um, moving on. We're not talking about Ethereum today, but we are going to talk about um the DXY. So one thing I am going to point out on the DXY is right now we are following a Wyckoff accumulation schematic um, in this area. Um, we are just letting you know. If you can't see it, I'll help you out. So we're following a Wyckoff schematic. Um, obviously there's ultra specific rules, but tell me these don't look the same, right? Tell me these don't look exactly the same, bro. You got your all right. So let's just go through it, right? Automatic rally, right here. I forgot what this is called. No, secondary test, right here. No, automatic rally, secondary test. Wait, no. Here, forgot what that is. Rally up, blah blah blah. It's like some sort of whatever. I forgot. I don't even have my Wyckoff notes with me. Automatic. I know this is an automatic rally though. Secondary test. I'm 90% sure. Some like right here, and then the fuck. But okay, fuck, fine, fuck. It's not completely textbook, right? But point being, it looks the fucking same. Like you got the spring event, right? You got the spring event over here, and you have a sign of strength coming up. Is what that's the point I'm making. Fuck, because I don't have the exact ultra specifics, but you get what I'm saying. It looks the same. My only thing here is that people are calling for reversal, and I'm like, I don't think that's the case. When what is strengthening the dollar is things like QT, inflation, inflationary data, um, how that comes in the short term, depending on the type of environment you're in, because inflationary data in a QE environment, like obviously that's going to weaken the dollar. But in an environment like this, when we get inflationary data, they raise the rate hikes, and that has more strength than the data coming out in the first place, in my opinion. So people are calling for like breakdown from here, reversal, and I don't think that's the case, because all we're doing is we're going to retest this zone, right? We're going to retest this zone, this breakout zone, and as long as we did kind of rejected the 50%, sure, but we're also trying to test the 38.2. So if we bounce off 38.2 and we get continuation, flip this as support, then upside and gonna get drawn to the 61.8. And maybe it doesn't come as high as we did here because they're not tightening as hard. But if we do come up to the 61.8, I wouldn't be surprised if we do get a bounce from here, because this was clearly some form of distribution. No, accumulation. Yeah, accumulation. Because if they're accumulating the dollar while it's weak, right? Weaker, and then asset prices are rising up, they sell off those asset prices, giving them weak dollars. But then when the dollar becomes strong again, all those same dollars became strong and those asset prices dropped, making this an accumulation down here. They're distributing the dollar back into those assets that dropped because the dollar went into strength, if that makes any sense. I think you guys get what I'm saying there. Clearly, this is fucking manipulated a little bit. They always do that shit. Market makers always got some shit to say. But moving on again, if that didn't make sense, how this is an accumulation in regards to other charts. The dollar is weak. They're selling off assets for dollars because assets are giving them a higher return than the dollar. They accumulate the dollar while it's in a weak phase, accumulating, and then when the dollar gains strength, they sell off that dollar for the assets at the lows. So it's an inverse correlation. When the dollar is being accumulated, the assets are in strength or weakness, and then when the dollar is in strength, the assets are in weakness. Now that I've gotten that out the picture, just going over something that is relevant: the total cryptocurrency market cap. And the matter of the fact is, um, we're with this retracement, coming in high to the low over here. I mean, I can make this a bit better. I had to extend the area, but there we go. So with, high to the low and extending that over, you're seeing we got a clear rejection off the 50%. We're getting a clear rejection from the 61.8, or failed support if you want to call it, and going down to the 78.6 breaks that neckline and gives us a target of total liquidity all the way down on total 2 to 329 billion. And that's going to be a drop of almost 33% in net liquidity. Now, if that doesn't frighten you a little bit, it should, because we could drop 50% if this access liquidity really needs to get sucked out this space. We really could drop 50%, and this is the next support region of potential resistance to flip support at that region over there, all the way back in 2020. Potential resistance, flip support. Okay, can I just, okay, there we go. Fuck. Like, damn, that was taking forever, bro. What? I'm just gonna change the color. Now we're gonna make this blue. So now that I gotten that out the way, obviously a total 2 is doing that. We can see what total 3 is probably gonna do, right? What do you know? What do you know? Total 3. So what total 3 is doing right now seems to be getting, I mean, honestly, I don't even think it's gonna get over here, but regardless, this is a symmetrical triangle. You zoom in a little bit, you see that we've had a fake out from an upside break. So realistically, got a downside price target of about 280 billion, which is not good. And if we go back to the larger time frame, and if we're talking 280 billion, right, and if we start talking about range, that's a retracement. Is that, no, that's Fibonacci retracement to the upside. That's if I wanted to do the upside move, but I want to do the downside move. So I don't know how I haven't had a Fibonacci retracement on here, but yeah, I just had to. All right, yeah, I just had to redo my recording, but high to the low, retracement tool. So you're looking closer, right? Obviously, we have that range, but you're looking closer on the retracement, and we couldn't get above 23.6. But if 283 billion is the target from the smaller triangle right here, obviously our larger triangle target would be in play. So one, obviously creates another, and then that would put us in a situation of continuation of the downside and a 50% drop in altcoins liquidity. And if you think that that's not going to wreck altcoins more than 50%, then I guess I got some news for you. And then our next potential region to hold support coming in around here, flip that possibly into support. Oh my god, fuck. Why? Just go. Just okay. It's one click. Okay, that's annoying because when you double click it, it just goes away for whatever reason. So yeah, there's that playing out. Whenever we break down, actually, did we reverse yet? Because if as soon as we reverse, it's already in play in my opinion. Because it really started. The micro move indicates the larger move. Say get past from. Obviously this is a fake out. So once we get past, if we can't. Let's be for real. Where's it going to go up? It had a chance to go up. No. So breaking below 314, I'm expecting this to start to trigger. That triggers, and then the larger one, once it hits this target, that might take a couple days. But then once this larger one hits that target, and then it's really going to play out on the weekly. Yeah, that's total 3, total 1. As in net liquidity for Bitcoin, we can see here that obviously we got to extend this just a little bit. Oh no, not that. This. It extend this over a little bit because that's not where it's trying to break down from. But obviously that's part of the neckline now. In my opinion, the fact of the matter is it honestly is like creating some form of resistance here. So hold on, zoom in, take this off. Because that only needs to be on the weekly. And then what do I got here? What do you know? There. Oh, bruh. And you guys are going to be like, how do you catch these things? I'm like, dude, you just, oh my God, bro. Come on, man. I don't know why it just does that. One click. Okay, there we go. You probably get that a little bit more accurate, but if this breaks down within this triangle, but then again, this is on the 3 day, so like if we get the same price action at this low just later, like we're breaking down. But yeah, we also got another symmetrical triangle to worry about. Maybe even tighter than I'm guessing. You see? Say this is a bit more valid than. Yeah, this works. Oh no, hold on. That's fine. So yeah, now that we got that, I think I made this loose. Like, yeah, this is in play, but if, like, we can even zoom in, even more, see what's really going on here. Bearish momentum breakdown. Yeah, yeah. And then this isn't even. Hold on, bro. What happened? Where did? What the fuck? Yeah, because I was like, I don't know what the fuck happened. Yeah, so obviously we got that little situation, couple bear scenarios. This isn't even. This is really following a trend line over here down, in my opinion. I mean, you can see that. I'm not gonna spend time fiddling around with this shit because it's so fucking annoying. But yeah, like trend line down, and it's not even like over. It's not even oversold yet. Let's see what's happening on 3-day RSI. It's the same thing. It's just kind of neutral. It's more neutral. I think this one's a bit more bearish though. No, they're both neutral. But yeah, I mean, like trend is to the downside though. But basically, that's basically everything right now in terms of liquidity, state of the market, and how that's going to affect everything. But just to recap, right? Just to recap. So we've got, CPI, PPI coming out higher than usual. That's strengthening odds of CPI coming out higher, increasing the odds of a rate hike because it's not the Fed what the Fed wants. That ties into jobs. Um, the jobs report could also influence them to have a higher rate hike probability if it's not revised to the downside, like the rumors or whatever data source is now saying. But if it's as high as it was, that might influence their decision. Regardless of anything, even with the jobs report being is what it is, even with the jobs report being is what, yeah, I just said that. Even being, fuck, God damn. With the current state of the job market, with said jobs being potentially, not even potentially, with them being lower quality jobs, and with them also being more part-time jobs and people picking up more than one part-time job, you're seeing a lower quality of jobs. Therefore, the jobs data is more manipulated because it doesn't include actually a higher standard. That's why it might be manipulated and could influence them to give out data. Well, clearly it's influencing them a bit to give out not even give out data, but give out a false projection of where the economy really is in their own minds, because if they let falsified standard data influence what they're going to do to the economy, then that's kind of like it's not benefiting either side when they're basing something off of a false narrative, in my opinion. But bringing that back into credit cards, if there's less quality jobs, then the banking system comes into the reality that most people, if they're not even most people, but if more people are depending on and living on credit cards, then you're obviously going to see more people not being able to make those payments with less quality jobs. And if you have less quality jobs, then you're going to see banking, we've already seen this play out this year, but banking liquidity be at risk, and especially with the yield curve the way it is, with a lot of these banks backing their balance sheet with lower interest rate bonds, they'll sell off those bonds at lower rates to therefore justify consumer deposits when requested. Them requesting those deposits causes their balance sheet to overall go in a net negative of what is required, and you start seeing news like bank runs being possible. But besides that, moving on, you have the M2 global money supply coming down and Bitcoin disregarding that temporarily, but but ultimately finding that it cannot do that on a sustained basis as we've topped out for this year. Um, and temporarily with the DXY doing what it's doing in Wyckoff accumulation, if it's following through with Wyckoff accumulation, then potentially on a longer term time frame, we can see and maybe expect some form of a Wyckoff a distribution pattern as we head to the upside if certain levels hold as support. Right, compare said zones if you want to compare said zones here. Bada bang, bada boom. That's accumulation and a distribution will look like this, just to let you know. Distribution. Do. And if we come up from this phase into this, that would make a lot of sense at some point, especially if we see the dollar start to maintain strength. Moving on past that, yeah, with the way Bitcoin is, I'm not going to go over the charts again, but how total market liquidity is being, from global liquidity being drained out the ecosystem. We're finally starting to see that reflected in the Bitcoin markets and total one, total two, total three, altcoin liquidity, and general market liquidity.